Welcome to Wealth Echelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your money. Your first credit card can open the door to financial freedom or lock you into a cycle of debt and regret. It's a powerful tool, but only if you know how to use it. The problem is, most beginners walk into the world of credit with zero guidance. They don't know the rules, the traps, or the long-term impact of a simple swipe. One late payment, one maxed out card, or one misunderstood interest charge can haunt your credit score for years. And that score, it affects everything. Whether you get approved for a car loan, a mortgage, even a job in some cases. The truth is, it's not just about having a credit card, it's about using it smartly. And that means avoiding the beginner mistakes that can quietly sabotage your financial health before you even realize it. In this guide, we're exposing the most common credit card mistakes first-timers make and showing you exactly how to avoid them. From misusing rewards to misunderstanding APR, and from ignoring statements to damaging your credit without even knowing it, we're covering it all. So if you're ready to take control of your credit and build a strong financial foundation from day one, this is where your journey starts. Let's dive into the top beginner credit card mistakes and how to steer clear of them. Getting your first credit card is a significant financial milestone. It opens doors to building a strong credit history, gaining access to loans, and learning the fundamentals of personal finance. But like any powerful tool, a credit card must be used wisely. For beginners, the excitement of swiping can sometimes overshadow the responsibility that comes with it. Mistakes made early in your credit journey can take years to correct, potentially costing you thousands in interest or damaging your chances at securing favorable loans in the future. That's why understanding the most common pitfalls is crucial. In this comprehensive guide, we'll walk through the top credit card mistakes beginners make, and more importantly, how to avoid them. Whether you're a student, a young professional, or simply new to credit, this guide will help you use your first credit card as a stepping stone toward a healthier financial future. 1. Only making the minimum payment. One of the most common and costly mistakes beginners make is only paying the minimum amount due each month. At first glance, the minimum payment might seem like a small victory. After all, you're not missing a payment. But the truth is, paying only the minimum traps you in a cycle of debt that can grow rapidly due to high interest rates. Credit cards typically charge interest rates anywhere from 15% to 30% APR, and when balances roll over month to month, that interest adds up quickly. Paying just the minimum also prolongs your debt and increases your overall repayment costs. For example, if you owe $1,000 and only pay the minimum, often around $25, it could take years to fully pay off that balance. And you might end up paying nearly double the original amount. The better strategy is to always pay your full statement balance if possible. This avoids interest charges entirely and helps build a strong credit history. 2. Missing or late payments. Another critical mistake is missing payment due dates. Payment history is the single most important factor in your credit score, accounting for 35% of your FICO score. Just one late payment can cause your score to drop significantly, and multiple missed payments can lead to late fees, increased interest rates, and even collections activity. Many beginners forget due dates simply because they're not used to managing bills on a schedule. Fortunately, this is an easy mistake to fix. Setting up automatic payments for at least the minimum due ensures you never miss a payment, even if you forget. Alternatively, set calendar reminders or enable notifications through your bank's app. Being consistent with on-time payments builds your creditworthiness, showing lenders that you're responsible and dependable. 3. Maxing out the credit limit. Some beginners make the mistake of using their full credit limit, assuming that it's okay as long as they pay it off eventually. However, this can hurt your credit utilization ratio, the amount of credit you're using compared to your total available credit. A high utilization ratio is a red flag to lenders, because it suggests that you might be overextended or reliant on credit to fund your lifestyle. Experts recommend keeping your credit utilization below 30% and ideally under 10% for optimal credit health. So if you have a $1,000 credit limit, you should aim to carry no more than a $300 balance at any given time. Regularly maxing out your card can lead to score drops, even if you pay your bill on time. The best approach is to monitor your usage and make multiple payments throughout the month if necessary to keep your utilization low. 4. Applying for too many cards at once. When you're just starting out, it can be tempting to apply for several credit cards to take advantage of various rewards or increase your total credit limit. But applying for multiple cards in a short period of time can backfire. Each credit application triggers a hard inquiry on your credit report, and too many inquiries in a short time frame can lower your credit score and make you look risky to lenders. Moreover, having multiple new accounts can be overwhelming to manage, especially if you're new to budgeting. Instead, begin with one good starter card, preferably one that reports to all 3 major credit bureaus and offers some basic rewards. Use it responsibly for several months before considering additional applications. Patience and consistency are key to long-term credit success. 5. Ignoring statements and account activity. One major mistake many beginners make is not checking their monthly statements or account activity. It's easy to assume everything is fine, especially if you're making payments. However, this approach leaves you vulnerable to unauthorized charges, billing errors, or recurring subscriptions you've forgotten about. Reviewing your statement regularly not only keeps you aware of your spending, but also gives you a chance to spot fraud early. Many credit card issuers offer zero liability for fraudulent purchases, but it's up to you to report any suspicious activity in a timely manner. Checking your account weekly, if not daily, via your bank's mobile app is a good habit that increases your financial awareness and security. 6. Treating a credit card like free money. Some beginners view a credit card as a spending tool rather than a borrowing tool. This mindset leads to overspending and eventually unmanageable debt. It's important to remember that a credit card isn't free money. It's a short-term loan that you must pay back. Every purchase you make is a financial commitment. Before using your credit card, always ask yourself, can I afford to pay this off in full by the due date? If the answer is no, it's best to wait or use cash or a debit card instead. Responsible credit usage involves discipline and awareness, not impulse and convenience. Using your credit card for planned, budgeted purchases, like groceries, gas, or bills, is the safest way to build credit while staying out of debt. 7. Not understanding interest in APR. Many first-time cardholders are unaware of how interest works. The annual percentage rate, APR, determines how much interest you'll be charged if you carry a balance past your due date. While you won't be charged interest if you pay in full each month, any remaining balance is subject to the card's APR, and that can add up quickly. Let's say your card has a 20% APR. If you carry a $1,000 balance for 1 year without paying it off, you'll owe an additional $200 in interest. That's a steep penalty just for delaying payments. Beginners should take the time to read their credit card's terms and conditions to understand the APR, grace period, and how interest is calculated. Avoid carrying balances unless absolutely necessary, and if you must carry a balance, try to pay more than the minimum to reduce the interest burden. 8. Overlooking rewards terms and conditions. Rewards cards are popular with beginners, but it's easy to misuse them. Many cards offer cash back or points, but often these rewards come with specific rules, such as rotating categories, spending minimums, or activation requirements. Some users get excited by the promise of rewards but forget to read the fine print, ending up disappointed or misinformed. For example, a cashback card might offer 5% back on groceries for 1 quarter, then switch to gas or online shopping the next. If you're not keeping track of these changes or activating the bonus categories, you could miss out on the advertised benefits. Rewards cards are most effective when you tailor your spending to the categories that offer the most value. That means being intentional and informed, not just swiping and hoping. 9. Closing old accounts. Too soon. Another misstep beginners often make is closing their first credit card as soon as they get a better one. While it may seem logical to simplify your wallet, this can hurt your credit age, which is another important component of your credit score. The length of your credit history matters, and older accounts help boost this metric. Even if you no longer use your first credit card regularly, it's usually a good idea to keep it open, especially if it doesn't charge an annual fee. You can simply use it occasionally for small purchases and pay them off immediately to keep the account active. Closing old accounts too early reduces your average account age and your total available credit, which can negatively affect your credit utilization ratio. 10. Not monitoring your credit score. Beginners often forget to check their credit score or think it's something only banks or lenders need to worry about. In reality, your credit score plays a crucial role in your financial life, from qualifying for apartments and jobs to securing favorable insurance rates and loan terms. By keeping an eye on your score, you can track your progress, catch any negative changes early, and stay motivated to improve. Most credit card issuers now offer free access to your FICO or Vantage score through their apps or websites. Take advantage of this feature and learn how your score is calculated. The 5 main factors, payment history, credit utilization, length of credit history, new credit, and credit mix, are all impacted by your behavior. Understanding these factors will help you make smarter choices and stay on the path to excellent credit. The right habits make all the difference. A credit card can either be a helpful financial tool or a dangerous trap. It all depends on how you use it. For beginners, the learning curve can be steep, but by avoiding these common mistakes, you set yourself up for long-term financial success. Start by choosing the right card, preferably with no annual fee. Use it for planned and necessary expenses, and always pay your bills on time and in full. Keep your utilization low, track your spending, and stay informed about your credit score and rewards terms. Building credit isn't about making flashy purchases or racking up points. It's about demonstrating responsibility, consistency, and financial awareness. With the right habits and a bit of discipline, your first credit card can become the foundation of a strong financial future. Avoiding these beginner mistakes will save you money, stress, and time, while opening up opportunities for better credit, lower interest rates, and greater financial freedom down the road. At Wealth Echelon, we're not here for hype. We're here to uncover real innovation, challenge the noise, and keep you ahead of the curve. If you found value in today's breakdown, make sure to like, subscribe, and hit that notification bell so you never miss an opportunity to decode the future of investing. Got thoughts on this project? Think it's revolutionary or overrated? Drop your take in the comments below. Let's keep the conversation going. Until next time, stay curious, stay sharp, and keep it investing. This is Wealth Echelon, signing off.